September 5th, 2023. There were a couple of leg one, leg two measured moves today, which are pretty common on trading range days. The 20 high to the 26 low. You put that on the 34 high, which is essentially the high of the second leg after this wedge pullback. And you can see that that was where that second move down ended. And if you think about it a little deeper, you can kind of see that this whole thing could be seen as one leg. And then you get a wedge pullback, three pushes, and then a second leg. And what I'm trying to get at is that this is still two legs. It's a bigger, oh, come on. It's a bigger two-legged measured move, which is exactly what we got here. And, the reason that'll happen is because if you look at like the 15-minute chart, you can see that there's much more clear. It's two legs here, but this is, seen as one two-legged move and then a three push pullback and then a second two-legged move, if that makes sense. So that's why you get, when you get a two-legged move on a higher time frame, it's still the same move on a lower time frame. You just have to think about it a little bit differently. I wanted to make a point about true risk too as well. So if you bought above bar 57, it was a reasonable buy, but I'll get to that later. You know that 42, right? So would you want to sell below 42? Probably not. This could be potentially, one push down 40, down up 41, down up 42. Yeah, I wouldn't buy below it, but some traders would. But my point being, I wouldn't sell on a stop below this. And so when you get on a surprise on bar 43, you have trapped traders who bought below 42. That's relevant because when you look at 57, any trader who bought above 57, your actual risk was only this much of the tail on 58. So if you bought above 57, maybe you had a 50% chance of getting, two times your risk. And actual risk is where your stop had to be to not get stopped out of the move. You don't know going into the trade what your actual risk is going to be. But once the market starts to race up, it's pretty clear that your stop only had to be a tick below where 58 ended. So your actual risk was really only from the high of 57 to the low of 58. And you can see two times that because you need to get two times your risk in order for this trade to be reasonable. And you can see that on 58, we got about two times it. And that 50, that's exactly where one tick below the 42 low is, where the traders who bought below 42 would be scaling in and buying more lower. And so you can see it's not random that the low of 42 where there are trapped traders is exactly where the 2-to-1 of the true risk is here. That kind of stuff is really common, and it's algorithms' ways of making it mathematically essentially more sound and more likely that we're going to get to this low. And something else a similar thing happened earlier with bar 10. If you bought above bar 10, where was your true risk, right? Where was your actual risk? The 14 low was. If you bought above here, you had to basically have a stop one tick below all the way down here. You didn't have to have it below 10. You don't know that going into the trade. But once you start to rally, it becomes pretty clear that your actual risk was the low of 14. So if you take two times that, that's around where we went to. There are a lot of other reasons we failed up here too, like failed breakout of the 18 bar range, but I'll get there in a second. Bar 1, bear bar closing near its low. It's a good bear bar. I just think that the context, I generally ignore this. So I just think the context, you're kind of in the middle. Here, I'll do this. You're kind of in the middle of a trading range from the prior day. This is just the SPY. It's basically mirrors the Emini. So kind of in the middle of a trading range from the prior day. So I don't really want to buy anything yet. But if you looked on the daily chart, you'll see that it's essentially a double top on the daily chart. And so you'd be interested to see what bears get below yesterday's low. Follow through on bar 2 and bigger follow through on bar 3. And you do have an open gap with the 1 low and the 3 high. And remember how, I'm saying a lot, gaps fill on trading range days. And, trap traders get out. It's because they do. You can see anyone who bought here, bought more lower, got out at break even on bar 12. But as of the close of bar 3, you have an open gap with the 1 low and the 3 high. Bar 4, there's a deep pullback in bar 4, and then it closes kind of near its low. But the problem is any bear who sold the close of 3 wanted another strong close below yesterday's low. Bears generally want, if you're at yesterday's low or yesterday's high, in this case, yesterday's low, bears want two strong closes below the low of the day, similar to if you were at, the prior day's high, you would want two closes above that area. And I know that 4 is a close below, but it's not a strong close. It's really just a doji bar. And after you get a sell climax, which is what this is, when you get an inside bar after a sell climax, a lot of times the market just starts to go sideways and might set up some sort of reversal. So when bears fail to get another strong close below yesterday's low, that's kind of, really not great. They don't love bar 4. You can see we get bad follow through bar 5 and 6. So now we have 3 straight dojis. This is likely a trading range. It's probably not a bull trend, which is true because of how strong this was. But these make it a lot less likely that it's a bear trend. Bears want to see another strong close below yesterday's low, and they're just not really getting it. And so when you get that, it makes it more likely it's a trading range. And if it's a trading range and we've had this, that means that we're probably towards the low of the trading range. And so you got to be pretty careful. It's okay to be short, but this just really is not ideal. 7, inside bar, but not quite closing near its low. Probably buyers below, probably sellers above. And then we get bar 8, which is the first blow close. Essentially, bears, saw this. Anyone who was short in here saw this as a good opportunity to get out of their shorts at a good price. And so they bought back shorts here. Bulls were buying below here, knowing, basically betting against bar 7 getting any follow through and assuming that this tight trading range was going to hold. Once you get bar 8, bears are pretty disappointed in bar 8 because it's the first blow close on the day. This was actually a doji on the Emini. I'm going to go back to the Emini. It's the same chart. It's just I just wanted to have this out of the way for the first few bars. So basically on the open of bar 9, bears started buying back their shorts and that causes the rally. But that anyone who anyone buying up here is probably only trying to get to the high of bar 8. We're probably going to get to the high of bar 8, but there should also be sellers above because it's the top of a tight trading range that we're still in. Bar 9, it's a low one short, but you're selling in the middle of a tight trading range. Probably buyers down here, probably buyers right here, so I wouldn't take it. And then you get bar 10. You could essentially look at it as 3 pushes down. 1 to 3 is the first push. This more sideways move from 4 to 7 is the second push, and 9 is the third push. I know this wasn't a technical pullback, but it's kind of implied that on a lower time frame. The way I think about it is when you get a strong move like this, even if the move continues, but it changes, you can see how this is different than this. When the move changes, I think of it as, a pullback and another push. So I'm trying to find another example of this. Not a lot of good ones on this chart, but I guess 40 to 42, you could argue is one push, and then you get 43, 44, and you can look at it as a second leg. That's not a very good example, though. But that's kind of the point I'm trying to get across here as to what I'm thinking right here when we get this, and then a third push wedge to bar 10. Buying above bar 10 is definitely fine. It's a wedge bottom, hoping for a swing up. And there's a 90% chance once we form the 18 bar range, we're going to break out of it. So if we start to get a move up and it stalls a little bit, you can still hold thinking that we're going to at least get to the high, which we did. Follow through on 11, close right below the moving average. Okay to be long. You can see we ended up getting vacuumed back to the one low, and that's where we found sellers. Some traders will look at, bulls will look at bar 12 as a breakout pullback, and bears are looking at it as a low 2 bear flag. And if it is a bear flag, if we break out above the bear flag, we could get a measured move up of it. And that's about where we went. You could argue that sometimes we're going to get a measured move of the whole thing, and that's true too. But, it's generally better to use the more conservative measured move for at least part of your profits. 13, follow through for the bears. Anyone who sold below 12 is very happy with 13, but there were probably buyers below 12, which means that we're probably going to at least get back to it. Generally on trading range days, you should expect stop order traders to be disappointed. So traders who buy above 11, disappointed. Traders who sell below 13, taking sell the close trades, buy the close trades, are going to be disappointed. So you get follow through on 13, yes, but bears want a collapse immediately. And if they don't get it, there's a lot of risk of a bounce. And the fact that this is potentially the bottom of a trading range is something you can't forget. You could argue it's some sort of expanding triangle in here. And that's a breakout pattern. But really just breakout mode is the important thing to remember. 14, bull bar reversal, but isn't quite closing on its high. It's kind of tricky buying above 14 because that if you buy above 14, there are bulls who bought below 12 and are disappointed in 13. And a lot of them are going to be getting out at break even. Some will hold, thinking that this is going to be a double bottom, maybe a wedge double bottom. Maybe we get back to the opener today. But a lot of them are probably just going to exit their longs right here. So it's kind of hard to want to buy above 14. Brad mentioned today that you can buy with a wide stop. If you don't love the signal bar, but the context is good, you can buy with a wide stop. Basically, measure move down to the bar. I think that's a reasonable thing to do. Big follow through on 15. Okay to buy the close of 15. I was looking at it as basically you got a double bottom, you got a wedge and then a pullback. So it's a wedge double bottom. Okay to take the swing buy. Again, when you're sitting at 15, do you think this is a bear trend? It's probably not a bear trend. So it's probably not a bull trend either. So what is it? It's probably a trading range. And in trading ranges, you want to buy low and you want to sell high. And scalp out of your positions when you get big bars. And so okay to take the buy above 15, hoping that we rally to maybe the open of the day. Occasionally on 16, you get a bear bar closing near its low, but even if you do, it's okay to exit, but you might get another bull bar and another setup. Follow through for bulls on 16. You have to keep in mind there's tails on 14, 15, and 16, so it could be a parabolic wedge top, and 16 could be a big parabolic move. 17, follow through for the bears, and then a small inside bar on 18. You can look at it as a wedge and then leg one, and you're hoping for a second leg up. And you know that after the close of bar 18, there's a 90% chance we're breaking out of this 18 bar range. And so if you're expecting a second leg up for the bulls, regardless of assuming it just basically breaks out above the 12 high, you can, realistically hope that we're going to get to the one high. 19, big bull bar. Basically, everyone's starting to agree we're probably going to get vacuumed up to the one high, and traders bought. You have a pretty reasonable equation, even if you just bought the close of 18. You could put a stop below 16, and you're still getting better than 1-to-1. And your stop probably doesn't even need to be below 16 because realistically, if we're going to get up here, we're probably going to go pretty quickly. If we start to fall back down, traders will wonder if we're going to break out below 10. So you probably want it to go pretty quickly. That's why in 19 rallied. Follow through on 20, failed breakout of the 18 bar range, a second failed breakout of the 18 bar range on 21, and a third failed breakout of the 18 bar range on 22. So now you have an II pattern in 3 failed breakouts of the 18 bar range. Generally, if it fails twice, it'll try to do the other thing. And when the market fails to rally above the 18 bar range, a lot of times, especially with an II pattern, traders will start to sell and hope that we get back down to the low. Once you break out, it's low probability that we're going to get back to the low. It happens to be one of the days that we did. 23, follow through for the bears. You might have to get back to the 22 low because it's a bad signal bar, but it is an II, so you do have to respect that. I think get out below 23 or 24 if you're definitely below 24 if you're a bull, but you can get out below 23 too. The problem with staying short after 23 is that that it's a bad signal bar on 18. So traders who sell above 18 and scale in higher, maybe at the high of the day, are probably going to get out at break even on their first entry with profit on their second. And so that's why 24 gets basically vacuumed down to the 18 high. 25, not as much follow through as bears probably want. They were hoping that to continue to get a collapse down, but the reality is this was 2 legs up. It was pretty strong, so we're probably going to maybe get to a 50% pullback. And you can assume that the trading range probably actually started on 19, like this upper trading range we might be forming, because you got a bad signal bar 18 and then a bunch of trap traders. So bears are going to buy back shorts around here, so it's probably going to be more sideways. And if you sold anywhere, 23, 24, or sorry, maybe basically 24, 25 close, 26 and 27 are pretty disappointing. A lot of buyers at the bottom, you can see. And I think we were kind of just trying to test the 15 high, which was a reasonable swing trade. And so there's probably going to be buyers there if we get there. Basically, it's a breakout pullback, a test of the bulls resolve at the 17 high. So double bottom here. You get 28, maybe an okay bar to set up some sort of double bottom, but bears probably need a second leg from this. You can see on 29, any bears who were short in here, maybe sold to close of 28, 27, not a great idea, but on 29, they're let out at break even and they're buying back shorts costing 30. 30 is an interesting bar. You can buy above 30, but there are problems with it. And I think that, it doesn't close above the moving average and you're buying in the middle of a trading range. You do have the 22 low as a magnet, so it's reasonable to think we're going to get there. But it's the middle of a trading range and you're buying, right on a pretty flat moving average and it didn't close above it. So I'm not really sure I want to buy above 30. 31, up, down, and then up again on 32. So you could think of this as 2 legs up. If I bought above 30, I would probably just exit the market on the close of 31 because I wanted a fast vacuum up to that 22 low and you're not getting it. 32, so maybe 2 legs up, but again, probably getting to this 22 low. And if it is 2 legs up here, you can see 34 is essentially a third leg, and third legs are low probability. So when traders who bought above 34 got 35 as bad follow through, they know they're buying a third leg and it's low probability. So a lot of them will just exit at the market causing 36. Probably going to get back to the 35 low or the 35 close. You can see we do on 37 and 38. And then we get an inside bar on 39. Probably buyers below, probably sellers above. I wouldn't buy below though, because it's just kind of risky considering that I wouldn't take either one of those trades to be honest, but just probably buyers below and probably sellers above based off the fact that you're selling at the top of a tight trading range and overall trading range. There's probably sellers, and you probably don't want to take a stop order entry below a doji. So that's what that's based on. But in reality, you don't want to buy below here because we can easily start to do this and you have to have a really wide stop. And if you sell above here, it's a better trade, but you probably have to have a stop far above the high of the day because if we get to here, there are probably sellers there. 40, you could look at this as leg one, leg two, and you could look at this as its own three pushes, or you could look at it as three pushes up for the bulls and a wedge top at 40, and maybe try to get a measured move down to the wedge, which we weren't quite able to get. I think 40 is maybe okay, but I kind of think it's like 30. If you sell 40, you're selling in the middle of a tight trading range, right on the moving average. So yeah, I think it's kind of tough to want to sell there. Follow through on 41 and 42 for the bears, but tails on the bottom. So, potentially a parabolic wedge on a lower time frame, and you're going to get a bounce. But you end up getting a sell off and a breakout of the essentially a parabolic channel on 43, which is low probability. So that's why a lot of the times after 42, you get a bounce on 43 or in this kind of context. 44, more follow through for the bears. But you know that traders who buy below 26 are probably going to make money. So selling the close of 44, maybe not ideal. You're also selling in the lower third of a trading range. I didn't get in on any of this. I didn't think that any of this was, all that awesome. Probably sellers above 45, probably buyers below. You can see we get bad follow through for the bulls on 46, buyers below 46 on 47. You can look at it as, one push down, two pushes down, three pushes down, some sort of wedge. But the important thing is that we're at the bottom of a trading range, so I wouldn't look to sell. I'd be looking for a setup to buy. Bad follow through on 48, on 49, not surprising, bottom of trading range, and then you get 50. 50 is potentially a double bottom, and you're in a support area, so it's okay to want to be long, but I don't think you really want to buy above 50. I'd rather wait. I used to do that a lot. I would buy above bars in certain areas that I thought the context was decent, but the there's a difference between this is all good context for a reversal. This signal bar just isn't enough. So you got to learn to understand the difference between, this is all good context. The context to the left is good. And then all of this context is good. And then this signal bar isn't quite what you want, but it's still maybe okay versus, just you're at the bottom of a trading range, so context is okay. But this really isn't great context for a reversal here. This certainly isn't great context for a reversal here. So you have to learn the difference between, having really good context up until a bad signal bar and having, being in a good area but not having the best context, if that makes sense. 51 follow through for the bulls, but not all that good. You can see tails on the highs. We're probably going to get, you can look at this as basically a bear trend and then a trend line break here, and then a retest in a higher low major trend reversal. But it's probably a major trend reversal on a lower time frame, not on this one because it's not extended out enough. So, and it's just there's nothing, it's not a major trend reversal. It's in a trading range. This is like we reviewed 2 legs down, but the point is this is okay to buy above, but it's probably a minor reversal is what I'm getting at. 52 doji bar, probably sellers above, probably buyers below, and you get 53. We're probably getting back to the 42 low. You get outside down 54, disappointing. So anyone who bought above 53, disappointed 54 is exiting during 55. And then you get a big bear bar 56, but I don't want to sell below 55. We're probably going to get back to at least the 55 low. To be honest, this is what bulls wanted. Sometimes when you have an obvious magnet like this, the market will kind of just make a microchannel and then vacuum up to it because most traders know that there's edge there. So when you get a pullback like this, a lot of the bulls are very eager to buy, and they'll just buy the close of 56, hoping we get a bull bar, and they'll exit if they're disappointed. And we get a bull bar closing on its high, 57, higher low, and traders take the buy. And you can see we get vacuumed up on 58 to around the 42 low. Bad follow through on 59. Probably sellers above, probably buyers below. We get some follow through on 60 to the 40 low, but I was still long, like 20% of my position at this point. And, I was still long 40% of my position at this point, and I exited 20% here. And I held on to the rest, and I exited below 61 just because I didn't think that we were going to go much higher. But I really didn't need to exit that last piece. The reason I was holding it was because, it's good to swing at least a piece of your position, but it is a trading range day, so that's why I was only trying to swing 20% of it. But realistically, I think it's okay to exit that below, 67 or on the close of 67 and definitely below 68. But whatever. But my point being, on 60, I was long 40% of my position, and I took 20% off, expecting that we were probably gonna pull back. So 61 is a potential wedge. You can look at it as three legs up, and you gotta be very careful. I'd probably get it along as below 61, but I wouldn't sell. So bad follow through 62, and then basically, disappointed stop order bears. If you see the close of 62 after you sold below 61, you're just gonna flatten, and that causes 63. Probably sellers above, probably buyers below. 64, 65, and 66 are they're bull bars and it's a bull micro channel, but it's potentially one push up, two pushes up, a third leg up in a trading range at the top of the trading range. So it's really, especially not great. So I don't really think I want to be long up here. I don't think I want to be long up here at all after this. And so that's why a lot of the traders, basically, when they get 66, rather than seeing it as a place to buy, they just see it as a great place to take profits, and they cause this big bar. 67, 68. I think you could sell below 68 for a swing. Sell the close bears are always in bears. Certainly sell below 68 and get follow through 69. But when you get 69, it's pretty climactic, and so bad follow through on 70. And you're in the middle of a trading range now. If you really wanted to, you could look at it as down, up 67, leg one, second leg 68, and then third leg down 69. But kind of hard to see the pullback between 68 and 69. Probably buyers below 71. You can see on 72, it's a small second leg from 69, or basically 67 to 69. And then, basically a breakout test on 74, getting back to the 68 low, maybe the 66 low, because traders who bought below 66 had a quick chance to get out at break even, but it wasn't really that good and it wasn't very forgiving. And trading range days are normally forgiving to scale in traders. So you can see on 74, 75, those traders were let out at break even. And then we got a dump on 66, 67, 68, 69, or sorry, 76, 77, 78, 79. You could argue, like I said, it's a second leg from 67 to 69. I think it's reasonable. So first leg, first leg, then two-legged correction, lower high, 76. But I wouldn't trade any of this. It's too late in the day. So I would probably just be flat at this point. On the daily chart, you have a couple of bear bars. So, I've been saying, I think that the 824 high is going to be pretty important. There should be buyers there when we get back to it. For what it's worth, too, I think there'll be sellers when we get to the 75 low, whenever we do. So let's say tomorrow we get back up to the 75 low. I'd be pretty careful about being long once we get back up to this point. On the weekly chart, I was saying last week, I think we're probably going to get to this high, and I still think we're probably going to get to that high. So I would pay a lot of attention to this high over the next couple days, and I would pay attention to this low tomorrow. For always in, it was always in short, probably on the close of 1 or 2. Probably stayed always in short. It might have flipped to always in long here, but I would say bar 11, bulls probably needed one more bar. But I think at the close of 15, the market was pretty clearly always in long, pretty clearly bottom of a trading range. Always in, probably back to short below, I would say 23, maybe 24. And this is one of those spots where it's tough because maybe it'll briefly flip to always in long here. But the reality is, if you're short in here for any reason and you're trading always in, it's really hard to want to buy up here. And if you do buy, you're going to be pretty easily convinced to sell again. So probably flips back to always in short, 41, 42, follow through. Probably back to always in long above 57, short below 68. I thought the stop order trades on the day, it's okay to buy above 10, but if you buy above 10, this is a decently tight bear channel, so you need to either scalp out or be willing to sit through a pullback. I thought you could buy above 15. If you do buy above 15, you get a bear bar closing near its low, which you sometimes get here. I would just exit below and then wait to see if you get another reversal up. But the reality is, if it's going to go, 15 should probably work. You probably don't need another reversal up. Maybe you can sell 23 for a test of the 18 high, but it needs to go pretty quickly, like it did. So if it starts to pull back, I'd be pretty quick to get out. Maybe 40, but it's on a flat moving average, so I don't love that one. I'm trying to be more careful with trades like that on flat moving average, where you're selling basically at the moving average. 57, good trade. Like I said, higher low, potential major trend reversal on a lower time frame. 3 pushes up, maybe 68. Just for limit orders, I guess I would say, probably buyers below 8, probably buyers below 9. Probably wouldn't buy anything up here. I guess maybe probably sellers above 37, but that doesn't seem like a great idea. Uh, this part I'm not very good at, so that's why I'm trying to work on it. Probably buyers, below 47, I would say, probably below 45 too. And I would say probably buyers below 55, but you don't want to buy directly below 55 because it could drop a little bit. Probably want to buy a measure move below. Why can it drop a little bit? Well, it's a small signal bar and you're potentially high in a small trading range here. And sometimes you'll just get a quick move. I'm trying to think of the logic behind it right now. I would say, um, just trying to think, uh, you know, disappointed bulls, anyone buying in here can maybe let 55 happen, but two straight bear bars, 56. They exit below, assuming this is a tight trading range, and that counts kind of a dump. Probably buyers below. Yeah, that's probably risky after that. But yeah, I don't know. That would probably be it for me on the day. And I think that's everything.